lot of things to cover, so let's dive right in. Starting off with big tech. We know you're bullish on pockets in the hypergrowth sector, small to the mid-cap size. But how do you feel right now about big tech now that we've seen some substantial declines in these names? Names like Meta, Netflix, Google, Uber, basically the FAANG stocks are trading at or at near decade low valuation multiples.
Yeah, Aaron, that's a great question. We do spend a lot of time talking about small, mid-cap tech, the next wave of disruptive technology stocks. But at the end of the day, big tech is big tech for a reason, and that's because they have built empires around delivering products and services of unrivaled quality that all of us use on a daily basis, a lot of us. Those stocks are, to your point, trading at or near decade low, if not all-time low valuations. And I think that's a pretty attractive setup for these stocks. I have been a noted bear on big tech for a while, going all the way back to July 21, I believe is when I kind of first went public with a bearish big tech slant, saying, Facebook is losing market share. The Facebook platform is all but dead. Instagram is losing share to Snap and TikTok, and Messenger and WhatsApp, while fantastic messaging platforms, it's just really hard to monetize messaging. So I was saying, hey, buyer beware on Facebook. I was saying buyer beware on Netflix. Competition was ramping. Buyer beware there. I was saying buyer beware on Amazon. Everyone's building Shopify stores these days. Everyone's building their own direct-to-commerce sites. Lululemon, Nike. Maybe the need for Amazon is eroding. So I said buyer beware on Amazon. So across the board, I was saying buyer beware on these big tech stocks, and that's because I felt like they were losing market share, and that remains true today. In fact, more true today than possibly ever at any point in history. Facebook is losing more market share more rapidly than ever before. Talent is leaving the company in droves. Netflix is really facing the competition struggles. I mean, subscribers are not even growing anymore. I think Apple TV Plus is making way better content than them. I think Disney Plus is making way better content than them. So they're losing market share more rapidly today than I believe they ever have in their history as a streaming company. And Amazon, I think, is really riding the struggle bus today because we're going into what looks like it's going to be a recession. Consumer spending is going to take a hit. The e-commerce side of things might take a hit as well because it's really tough to see, with oil prices and gas prices where they are, Amazon continuing to offer free delivery on all items. Maybe they cut back a little bit, and if they don't cut back, that's going to be a hit on profit margin, so that's going to hurt the stock. So I think that these companies are facing bigger challenges today than they've ever faced. Having said that, the stocks are priced for that. Okay? So we look at Netflix stock. I mean, I got the chart pulled up right here in front of me. Netflix is trading at 2.6 times trailing sales. A couple months ago, it was trading at 10 times trailing sales. It's averaged a 10 times trailing sales multiple for 2 years, 2, 3, 4 years now. The last time it was this low, 2.6 times trailing sales, gotta go back to 2013. When this company was still trying to figure its identity out as a streaming player. Remember, in 2012 was when they split the DVD mail business and the streaming business. So we're talking a year after that split. This company's still trying to figure it out. Wall Street's not confident in the streaming narrative. They're not sold on it. At that point in time, this was a 2.6 times trailing sales company. It's a 2.6 times trailing sales company today. So that valuation setup, pretty attractive for a company that we know is going to keep growing, right? Like I stated, they have massive competition challenges today, no doubt. But I still have Netflix. My parents still have Netflix. My friends still have Netflix. Aaron, do you still have Netflix?
I still have Netflix.
Netflix still makes great content. I think the others are making great content too, but Netflix still makes great content. This most recent season of Stranger Things, boom, mind blown. fantastic. That final episode, that cliffhanger they're leaving you for July 1, which, by the way, is my birthday, so that's going to be the best birthday gift ever. But that last episode was, I mean, I was just, whoa. I rewatched it like 3 times. That's how much I loved it. And I just think Netflix is still making great content. They still have a great service. At 2.6 times trailing sales, all I need for them to do to make the stock work is pull off 10% revenue growth a year with some marginal profit margin expansion. That seems very doable. If we're talking maybe mid-single digit subscriber growth, throw on mid-single digit pricing growth, margin expansion through economies of scale, figuring out better ways to produce content, more cost-efficient ways to produce content through price hikes, seems pretty achievable. Very, very likely they pull off 10% sales growth with some margin expansion and turn this into a low teens, mid-teens EPS grower. 2.6 times sales for a mid-teens EPS grower. That's a really good setup. So I like what I'm seeing with Netflix stock. Was bearish. I think maybe it's time to start getting semi-bullish, if not full bullish, on Netflix stock.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.